at the end of the panel discussion, we will also leave some time for Q&A. During this presentation and discussion, you will be all muted. So if you have any questions, please leave your questions at the end and leave your questions in the Q&A box below. So first of all, next slide, please. So first of all, we would also like to recognize this webinar is in partnership with the City of Austin's Economic Development Department. And we would also like to thank all our corporate partners for their support. Next slide, please. This event is also co-hosted by National ACE, whose mission is to support and promote issues that impact the AAPI business community. And today, we have National ACE CEO Chilling Tong here to join us. And Chilling has served as a president and a CEO of National ACE since 2017. And now I would like to hand it over to Chilling for her to say a few words. Welcome.
Thank you so much. Thank you. We would like to welcome all of you to our event today. Access to funding during COVID-19. I want to especially thank Marina. Marina has been great leader and we work closely with each other. She always come to Washington, D.C. She always bring very good information from Great Austin. Thank you, Great Austin Asian Chamber of Commerce, for all the board of directors and the volunteers, and the City of Austin's Economic Development Department for hosting this event with us. My name is Chilling Tong. I'm the president and CEO of the Asian Pacific Islander American Chamber of Commerce and Entrepreneurship. We call National ACE. We locate in Washington, D.C., and we are a nonprofit organization committed to mobilizing resources to advocate and provide assistance to Asian American Pacific Islander entrepreneurs in the United States. Since COVID-19, we have been working closely with the federal agency, the administration, and also Congress, try to make sure we are the organization that gives a voice to the business interest of the AAPI community. Most recently, we joined with other minority organizations like a Hispanic Chamber, Black Chamber, to call all Congress to mobilize more resources in grants, loans, and technical assistance directly for minority small business and nonprofit. These are difficult times. Many small business and nonprofit organizations are struggling to survive during this pandemic. As a national organization, we are just so pleased to work with Austin Asian Chamber and and other partner organizations throughout the country. It is important for us to communicate other funding options as a business are pivoting the changing during this pandemic. I also want to thank all our speakers, moderator, and today's webinar for joining us for this important topic. Among all the speakers, I really want to thank Arun, Jonathan, Yongro, and I want to talk about Yongro. He is our next gen, the leader of our next gen group. Next gen is a very, very important part of National ACE. And Yongro has been working with all other next gen leaders throughout the country. So we'll have him to share with you about our next gen community. Thank you.
Thank you, Chilling. Also, thank you for National ACE's support. So next slide, please. So next up, I would like to introduce today's moderator, Shakeel Rashed. So Shakeel is the Managing Director of the Accelerator Program at Capital Factory, so the center of gravity of all things startup in Texas. And he's also a longtime Austinite and founded a few startups in his career. He's currently focused on AI, ML startups in Texas and all over via HBS Angel Network. So now I would like to hand it over to Shakeel, and he will introduce today's panelists. So thank you. Welcome, Shakeel.
Thank you. Thank you for the introduction, and thank you, Chilling, for getting us started on the panel today. Today we have three very distinguished panelists with us. I'm really looking forward to talking to each one of them. I will have each of them introduce themselves, starting with Jonathan.
Good afternoon. Thank you all very much for an opportunity to participate. I can assure you I'm going to learn as much from participating in the panel as those of you who are watching and listening, and I look forward to helping answer some questions at the end. I relocated to the Round Rock area, the Austin area, about 12 months ago from Bryan College Station with my family, and accepted an opportunity here to help Vera Bank grow in what is a more metro market. I'm very excited to be here, and Vera Bank helps customers in needs from those startup companies to multi-million-dollar borrowers, kind of everything in between. And I know that we're going to address some of the topics around what the niche is for each panelist. And so with that, thank you again for the opportunity, and look forward to participating.
Excellent. Thank you very much, Jonathan. Great to have you. Arun, would you like to go next?
Sure. Thank you all for having me as well. My name is Arun Prakash. I'm been in Austin for about 12 and a half years. And my background is across a number of areas, firstly an engineer, then a private equity investor, and now I'm a startup executive here in Austin at a enterprise software company in the AI space called Cerebri AI. And along the way, I've been an angel investor and early stage investor of a number of companies. So happy to be here.
And Yongro, you got a little intro during Chilling's talk. Please go ahead and continue on that.
Thank you for having me, and thank you all for tuning in. I'm sure this is not an easy time for any of us to do anything other than survive. So on that sense, I am the founder and CEO of NextSeed. I'm based in Houston. We are an investment crowdfunding platform. For the purpose of this conversation, I'll be talking about how there might be alternative sources of capital, or rather alternative ways to raise capital during this period, whether you are a startup or a small business, which is, as I'm sure we'll talk about, one of the areas that's obviously been hardest hit, and unfortunately the least amount of sources of capital available, because traditional capital isn't going to be providing. So on that, and just briefly on the ACE NextGen, which is affiliated with ACE National, as Chilling mentioned. We are a separate but related organization for more younger entrepreneurs. Really, the kind of problems that I think younger entrepreneurs face is slightly different than more mature founders or experienced founders and businesses. So there's different aspects to obviously everything we're dealing with, and we try to provide as much value as we can to the entire ecosystem.
Excellent. And Yongro, I understand you are a lawyer from Cornell, right? What brought you from law to helping with alternate funding sources?
Yeah, so I mean, actually, I practiced as a lawyer for 7 years, or almost 8 years actually. So I started my career in 2007. For those of you guys who remember, that was the previous Great Recession, and that was really my entryway into the world of finance. There was a lot of disruption since then, and if you think about really the tech world, actually after the last Great Recession, 2009 was when really this whole energy came to be in the startup space, and we've seen that 10 years after that, which is now. I practiced for 8 years, really internationally, focusing on private equity, because that's really what I sensed the value of the capital markets. Public markets were inefficient, and obviously that caused a lot of issues in 2007, 8, 9. And that's kind of really why I just said, hey, I think private capital is more flexible, more, frankly, can do more things than relying on public capital markets. Fast forward into my career, about 6 years ago, I started NextSeed because of changes in securities laws, specifically the ability for private companies to raise capital online from non-accredited investors which was literally illegal until this new law called Jobs Act happened. And it only became effective as of 2016, so we're in year 4. There's been a lot of changes since then as well, including just yesterday, the SEC announced changes to the definition of accredited investors, which basically will allow even more professionals to participate, even if you don't necessarily meet the $1 million income test. And so I'm actually looking at this two-sided, not just the companies that are looking for capital, but for other people who want to invest in private capital that couldn't do so before unless you had super amazing connections to Arun and Shakeel. You can't do anything, but now potentially there is more opportunities. And I think intersecting that demand for capital from the entrepreneurs who are looking for such, the supply of capital from investors who would like to do so in smaller amounts, that's kind of the intersection of this, changes that NextSeed represents.
Excellent. That's a great point you brought up, Yongro, in terms of basically defining what an accredited investor is, right? And like you said, there has been changes in 2008 on that definition, and just yesterday, SEC released that. So maybe that's a good place to start, right? Could you define what that means for?
Not to get too technical, but I think Arun probably will talk more about that when he speaks. But previously, generally accredited investors, right? You basically have to be a millionaire in terms of millionaire net worth, not counting your house, or make over $200,000 income for basically 3 years. So roughly speaking, that's you got to be rich, and it's ironic, right? You can't invest unless you're rich, and that's what a lot of people had issues with. The new changes that SEC proposed yesterday, among other things, basically will allow anybody with financial certifications, such as Series 7, Series 65. So for example, if you're sophisticated to be able to advise other people on how to make investments, of course, you should be qualified yourself to make these investments. There's different rules, like in terms of LLCs and registered investment advisors that on behalf of their clients who may not be accredited investors can also participate in private investments. So it basically broadens the audience who can invest in these private exemptions and private offerings for these rules. But the reason why it's relevant for this conversation is for the private companies that are looking for capital that cannot access it through traditional sources, such as bank, which if you can get it, you should definitely get it, because bank financing is usually the best form of financing from a cost perspective. But if you can't get it, now you have a broader audience of private investors that you can potentially access for either growth or working capital.
Excellent. Arun, do you want to add anything to that in terms of finding or how this definition or the newer definition will help entrepreneurs find funding easier?
Yeah, I actually don't think the latest changes will increase the size of the market, to put it that way, that much. I think it still has the net worth limitations, which are I think the main obstacle for getting more people involved in the private capital markets. So it may increase it somewhat, but I don't think it's going to be a game changer.
Excellent. I'll go to Jonathan a little bit here. Jonathan, you were basically in banking most of the time after you've been in banking for quite some time. What are some of the changes that you have seen, and also what brought you to Austin from College Station?
So yeah, thank you. We were excited. I will say, and those of you that are married probably feel the same thing. You rely on your spouse for a lot of help with big decisions. And so my wife and I were kind of looking to make a change, loved our time in Bryan College Station, but both grew up a little bit closer to a major metro area in Dallas-Fort Worth. And so enjoyed some of the things that a big city has to offer. I would say this type of a panel discussion being one of those things, right? The ability to interact with a lot of people from diverse fields. And so, I'll talk a little bit about the way banking, I've seen it change over the years and that really has accelerated maybe in the last 4 or 5 years. So it's been almost 20 years in banking, but the last 4 or 5 years have been much more dynamic. We all know that money is a commodity, but banks, I don't think, have treated it that way. They haven't really thought about it in terms of people can access that commodity in a lot of different mediums. And certainly some of the things Capital Factory or NextSeed are providing are alternative ways to access capital at a cost that, I think over time competition will drive it down and come closer to what it costs you to borrow from a bank at some point. There's always going to be a bit of a premium there, but I do think that those two will start to come closer together. And what I've seen on the banking side in the last 4 or 5 years is an understanding by the bank that people may come to you with different forms of capital. We're talking a lot about rich folks and this accredited investor philosophy. Banks historically have had a barrier to folks who are starting up their business and not using all of their own capital. We wanted you to have as much invested as you still had in liquid assets, and that's just kind of an unreasonable hurdle, right? If you're by definition starting something up, you haven't had time to formulate all those reserves, cash reserves, ample liquidity, et cetera. So I think you're going to see an acceleration of banks recognizing that they're dealing with individuals who have an amazing skill set to bring a disruptive new business, a new way of looking at or using real estate to the market. And we're going to have to be accepting that they're going to come to us with a capital stack that looks a little different. That's what I'm seeing really change. Most recently, you've seen a lot of private placements. So you have a sponsor bringing 5% equity, but you're seeing that that capital raise happen through a private placement. And so banks have had to change their underwriting and think through what those, what the return to those investors might look like and when we would allow those funds to start leaking out or being distributed to investors. So, it's a dynamic time where we're seeing pressure from fintechs to deliver services in a more individualized manner, but we're also seeing on the lending side a real change in how projects are capitalized.
Hey, could you tell us a little bit about Vera Bank? Last time when we spoke, you kind of mentioned it similar to a smaller version of Silicon Valley Bank, right?
So yeah, really interesting. Vera Bank has its roots in Far East Texas, but our CFO is an Austinite, and so he relocated about, it's been about 30 days ago. He's moved back to the Austin area. And so you're going to see and hear a lot more about Vera Bank, and I think that the uniqueness is that everybody has a niche that they fit in community banking, and each bank has preferred types of opportunities that they will pursue. And so having a good discussion with your bank and partnering with your bank in terms of just describing what it is that you're looking to do, what you're looking to accomplish, and let that banker become kind of a trusted advisor to you. We're talking about Silicon Valley Bank. They have this really unique niche just in the IT world, and not everyone possesses that experience and knowledge and comfort level. So talking to that banker and figuring out what they have a real appetite for, they can still help you even if they're not telling you yes for that specific opportunity. So, Vera Bank we are generalists. We don't specialize in any one field. But we can have a good discussion with someone, and the obligation I think we have as bankers is, when you talk to a customer, if you can tell that that's going to be a project you can engage on, tell them that. And if it's not something that's going to fit in the wheelhouse, help them find some resources. Maybe that's another bank. Maybe that is an alternative funding source, but still become their partner in helping them grow. That'll pay rewards in the future.
And what are some of the changes that you are seeing in your banking world with respect to response to COVID situation? Has the funding or other areas changed because of this recent change in the market?
So, initially it was a kind of, we call it pulling in our horns. It was certainly a time when we ceased lending activity and, ceased engagement with new clients because we were trying to digest some of the stimulus plans that were going on, and we were trying to understand how this pandemic would really impact different industries. We're now at a point though where, you know, I would say not unique in our understanding of the way that it's impacted specific industries, but we're now aggressively looking to grow. The great thing about the bank is we have a very strong balance sheet and a strong desire to grow, specifically here in Central Texas where there's more opportunity. So we're now re-engaging with borrowers, and we're seeing a ton of pent-up demand. You know, we paused the world for 90 or 120 days, and so we're seeing a huge amount of pent-up demand, and we're seeing borrowers and new clients come to us with I think a really good understanding that when they engage in dialogue with us, they talk immediately about how this pandemic, how COVID has impacted them. So in most cases, we're finding they're well prepared. They have an expectation. They need to address that up front. And we are asking a lot of probative questions just to understand specifically. And I would say that in so many areas we're finding, and maybe it's 50-50, it's that people persevered, adapted to changes in business very quickly. And so that has increased revenues, may not have increased net income. There may have been some expenses that were tied to changes related to COVID, but certainly we're seeing a good trend and seeing them stabilize coming through the pandemic and, getting us back to what normal will be.
Excellent. Thank you. Hey, Arun, I'll focus on you a little bit. You've gone from aerospace engineer all the way to doing the kind of work that you're doing. And even in this COVID situation, you have a very unique perspective because you are raising funds on your own. You're helping other startups raise funds while looking at deals for yourself to fund these. So can you give us a good perspective from that side based on the changes that have occurred during this time?
Yeah, sure. So I guess the main thing related to COVID is that I would say is, don't think you have to do something in a certain way. It means go back and start from the first principles, which is you're talking about being an engineer first. That's what you do as an engineer. You go to first principles. So when you think about funding your business, you have to the first principles are inherent in your cash flow statement, which is divided into the 3 ways to deal with cash. And 2 of those ways bring cash into your business. Most people think about fundraising. That's the second way. The first way is operations. And so first, and the lowest cost of capital potentially is the cash flow from operations. So if you can come up with ways to drive more cash coming out of your business, that's going to bring you much more value than any other fundraising project. So that means finding ways to get revenue, advances on revenue, or reducing costs, or doing things in a way where your customers can maybe invest in the business, et cetera. All the classical bootstrapping techniques, which we can certainly get into. But that's where, if you go back to first principles during COVID time, because the public markets and the private markets they're totally different. In March and April, they were out of whack. And this is where companies really had to go. So secondly is then, when you think about financing and when you get to the financing point, there are a lot of sources. And the next way to think about it is, the risk reward, trade-off is what drives the financing you can get. High risk, you have to give high reward, high cost financing, equity. Lower risk, you can get lower cost financing, bank debt. And in between, there's a number of different ones. There's high price debt, unsecured debt, mezzanine debt. There's merchant cash advances out there that will, charge you exorbitant rates, but you get the cash. So, there's a lot of things out there you have to consider. So opening your mind to not just saying, I have to go raise from a venture capital fund, or I have to go to my bank, but finding out the range of things in the middle are really going to help you as a business owner find your ideal and best suited capital structure for your current situation. So that's on kind of the, as the operator, the entrepreneur side. As an investor, it's clearly, my view is, as an investor, I'm more of an equity investor. So I take those higher risks. So I personally am looking for ways to reduce my risks during this time, which is, and increase my rewards, of course, but reduce my risk, looking for businesses that have an angle toward COVID, which is more geared toward digital transformation, or businesses that are, providing solutions that are going to help people with a touchless or a socially distant world, such as better technology to check into a hotel, for example, so you don't have to interact with the lobby. You can do it on your phone, or other technology like telemedicine. So that's really what things that me personally I think are exciting during this time. Obviously, businesses that are traditionally strong, that were strong before COVID and maybe have a reduction during COVID, are interesting investments as well, because investors like going for equity are long-term investors. So you want to have a fundamentally strong business anyway. And so those are areas where you don't stop looking at it as an investor. You always want to keep in the game, but maybe you can get better pricing for those kind of deals now.
Thank you, Arun. Yongro, in terms of, Arun mentioned high risk, high reward, or alternative finance in this case, right? What is the perspective from that world in alternate financing?
Yeah, I mean, so I'll focus on, let's just call it investment crowdfunding as a category, because that's what I represent. I can talk about some others as well. But I can tell you that since the COVID happened across the industry, investment crowdfunding has exploded, like literally like highest record number ever, like VCs and bank finance has gone down, investment crowdfunding gone like straight up. It's the same dynamics that we mentioned in terms of a digital transformation, right? If you think about it from the companies and depending on the attendees, I know, so I'll just say this, it's very different if you're a tech startup versus a Main Street business. So having said that, in general, no matter what, if you're looking for capital the old way from private investors, what do? You got to call people, email them, meet up for coffee, drinks, dinner, blah, blah, blah. And you do that over and over again. It's an extremely inefficient process. And frankly, it depends on who you know. And if the people that you happen to know that you meet doesn't like you, you're out of luck. Versus if you have an actual really interesting product or really interesting business, and you can tell your story online to literally millions of people instantly, it's a completely different dynamic, right? Because to be honest, a lot of the power dynamics go from the investors, especially in smaller communities where there's very few people, again, because of the credit investment limitations, who can invest, versus a lot of people that can invest. So I would definitely encourage any small business where if you know you have a solid business and you want a way to better tell your story, if you just Google investment crowdfunding, there's a lot of different platforms that specialize in different aspects, whether it's equity, debt, tech startups, small businesses, and so on and so forth. On the small business side that I do want to touch on, because that's primarily where NextSeed has focused on versus more kind of tech companies. Obviously for most small businesses, they're not high growth, right? What I mean by that is nobody's trying to go make a restaurant to 100x equity value. It just doesn't happen. What they're really looking for is cash flow. So that's why a debt financing is traditionally better for Main Street cash flow oriented businesses. That's also very difficult, especially because as Jonathan mentioned in the beginning, maybe they're a little better now, banks just stopped. Like you're not getting a loan no matter what if you're a restaurant. I don't care who you are, you're just not getting one. So that's the kind of context in which we've been able to actually successfully still support some businesses, including there's actually an Austin business, a cruise boating company that had a lot of success. Obviously in COVID, zero, right? Who's gonna? I mean, you can't go have a party. We launched a product of Community Bridge Note, which lets businesses raise capital from people on a revenue share. So people will be getting paid, for example, 4 times their investment, over 4 years, 1.3 times their investment on a monthly basis cash flow, but beginning in 2021, right? So that we give the businesses a chance to stabilize, prepare, weather this. Hopefully the world is a better place in 2021. And it's basically a mezzanine type of financial structure that investors can participate in and the businesses have access to, because otherwise there is no other option. So basically to I think kind of summarize everything I just said, if you have very strong personal credit and very significant personal assets that you can secure to get a bank loan, you should definitely do that, because no matter what, if you have the cash, bank will then give you the money. If you are a high growth company that is specifically good for this under this environment, like digital transformation, Zoom like companies, there's probably more demand than ever from VCs and angel investors to back you. So you should explore that. Anywhere in between, this is the brutally honest truth. There is no easy sources out there. So you do have to explore every single thing. And I do want to obviously encourage people to look into investment crowdfunding as another source of capital they can potentially access.
Thank you, Yongro. Yeah, that makes sense, right? In terms of whether it's high tech, things that VCs like versus things that banks and others. And then there is in between where a lot of people fall into and have trouble raising money. Can you give us a specific example of a recent investment that went through NextGen for something like that?
Yeah, so literally, I mean, right now, the Austin company that I mentioned, we have another, like in New York, we're doing a small loan debt raise for a childcare facility. That's gotten really great press and things like that. This is in New York. And in Houston, we raised capital for a business called Chipmunk. It's basically a keto, basically like a dessert company for diabetics in terms of their sugar content and things like that to be more healthy. It's a pure CPG product in all online distribution, online e-commerce, which is again very important in this market where you can't necessarily show up to a store to buy something. So they've actually raised, again, not that much money, but $150,000 in like a week. Just got funded because people saw that and believed it, and they did in this specific case, they raised their convertible notes, from like 100 different investors.
And what are the general terms of some raise like this in terms of?
Everything depends. I mean, just like it's not any different from probably what you hear for Capital Factory. People come to you with some terms that they want to go. You probably give them feedback. Right. That's stupid or that's silly or okay, that's appropriate. Right, yeah. So that's kind of that kind of dialogue. We actually operate as a broker-dealer. So we're registered by the SEC. We're basically an investing bank digitally operating via our online platform. So we try to provide that feedback to businesses so that if they are listed on our platform, they have a very strong success or probability of success. So we funded over historically 95% of all deals that we list on our platform.
Excellent, thank you. Arun, can you also add a specific example, maybe something from the recent engagement like Laundress that you have been working with, or your own to add to that?
Yeah, sure. I was going to talk about Laundress because they have a nice COVID angle. Laundress is a company that was bringing technology to commercial laundry, and kind of their market positioning before COVID was to go to hospitality and corporate cafeterias like Facebook's campuses in Austin and provide that commercial laundry service. So to bring an operational efficiency to the equation. And with COVID, their hotel customers and even their corporate customers who started sending people to work from home went away. So their revenue basically went to zero for 1 month. And they quickly figured out that they could service the hotels that are being procured by the city of Austin for COVID patients and COVID related staff called the Pro Lodges. And so they're helping with them. And they're now going to market with a positioning of, not only can we do the operational efficiency, but we can now provide that technology chain of custody on your linens to prove that they have been washed, they're clean, they've been washed since the most recent stay. And all the things that we're going to care about now going forward as we stay in hotels. So I think it's a great example of a pivot of a company's positioning with the same technology and operational backend, but a more appropriate marketing positioning going forward. And so I've been working with Laundress for about 2 years and have invested some money in them. And so I'm excited about what they have now kind of going forward. You're on mute still, Shakeel.
So how do people reach Arun, you, Jonathan, and Yongro from here? And what is the process that they go through to reach you or people like you?
Yeah, for me personally, I try to invest out of a entity called Carbon Arrow. So carbonarrow.co is where you can find me. But people like me, I mean, you really have to search. I get messages in LinkedIn a lot. It's kind of what Youngro was talking about earlier, it's very painful. It's a lot of work, and it's just, it's tough. I mean, I don't think it's that easy. And just finding people, personally for my company that I'm raising funds for, I'm approaching family offices and VCs. I bought a PitchBook subscription, and we started, emailing people that fit our categories in PitchBook. PitchBook, the cheapest price for that is about, 15, 20,000 a year. So it's not by any means an easy purchase to make, but sometimes you have to do that. So those are just kind of the things that I've done. But I think platforms like NextSeed and others are really, really strong. Very helpful for the community to get in front of a lot of people.
Yongro, do you want to take that?
Sure, I can go next. Yeah, so, likewise, exactly what Arun's talking about is the pain point in private fundraising. Obviously, every startup angel investor, startup entrepreneur would love to talk to Arun or people like Arun who have a lot of experiences. The problem is, just to be blunt, Arun's biggest resource is his time. And so he has very little time to give. And that's always a challenge for startups. So that's kind of where, if you apply to platforms like ours, and again, like different platforms have different specialty. And so you kind of have to do your research as well. But the benefit is if you do apply and you get approved, because every firm also has their own requirements on frankly what companies they'll work with. It's the process of marketing your deal to let the investors come to the platform to see what's there versus you trying to find which individuals may be interested, spend all the time to kind of get to them, let alone convince them to invest. And again, that's a very expensive and time-consuming process. So this is, again, not for everyone. The one, for example, if you do kind of the public route, the other side of this is nothing's private. You literally have to open up everything and show your financials and documents. You have to be very confident about the story you're putting out there versus obviously in a private transaction, you can keep things a little more confidential. So that's the different trade-offs that you have. But the online platforms typically all work the same way. You apply, you either get approved or whatever dialogue that happens, and then once you go up, that's when you start engaging with actual people.
And do you want to give out your platform, your site?
It's just right. Our website is NextSeed, NextSeed.com. You can just email info@nextseed.com with any general questions, and we'll be happy to answer them. But you can find all the important information online as well. If you're a business, there's an online application you can submit in a matter of minutes, and typically we turn around very quickly if you have all the information. So we can go from start and receiving information to launching your entire deal, including all the regulatory filings. If you have everything ready, surely in a matter of weeks.
Excellent. And same thing with you, Jonathan?
Yeah, thanks. So hopefully you guys can see, we have the Vera Bank logo there, just verabank.com. And you can kind of identify us by location. We don't have an Austin proper presence. We're negotiating leases right now. So you will find our physical locations in Williamson County. If we have a couple more minutes, I kind of want to throw a question back to Yongro and Arun. And it's from this perspective. I think one of the things we generally find with folks coming to us looking for capital is, we have this expectation and we put this burden on them of providing a lot of information. And the more professional, concise, organized and detailed that story is, or the story that information tells is, the more convincing the opportunity becomes for us. And in the NextSeed world, are you allowed to help that prospective client or the person raising capital by advising them on, improving financial reporting or giving them resources to put together a little bit kind of prettier package, if you will?
Yeah, absolutely. On our side, if you look at nextseed.com, all the deals, you can kind of assume, how much effort that takes to actually get to that point. And most small businesses probably don't have the resource by themselves to do it. So that's part of our service fee, is we help you raise capital, and then our service fee is a percentage of the amount raised. Right? That's how this process works, just like any kind of investment banking process. We're just making that available service. At least my mission, my goal is like the services that I used to provide to, for example, my clients were literally billion-dollar private equity firms. I wanted to do that, if not exactly that, something that comes comparable to at least that level of professionalism on basic documents and disclosure, things like that to small businesses. So we provide templates and kind of information flow. And then a lot of small businesses, I mean, at the same time, right, like nothing's free. Like they do have to engage their own counsels if they need specific advice on their corporate documents. They need to hire their own accountants if they have to provide certain type of review financials, which is a requirement under the securities law sometimes. If you're really messy, right, like there's nothing you can do. Like you need to reorganize, you need to hire, form a Delaware corporation, or redo your books. So like what we do is to inform them, if you really want to be taken seriously from the general public, then you need to meet a certain minimum level expectation that does require some cost and some time. And yes, you have to meet those to be able to do this. So this is definitely not Kickstarter, right? Which in that case, yeah, you can literally list whatever you want and people will give you money, but the investment part is a very different dynamic. So what I typically tell businesses that are looking for this alternative option, just because you have another way to raise capital, such as via investment crowdfunding, it doesn't mean that money is necessarily going to be easier to get, right? All you're doing is distribution of information is more broad, but at the same time, like somebody like Arun, like they're not going to just throw money at something just because they see something online. They think it's easy, right? Like they're still going to evaluate you. They're still going to understand and analyze the business. All we're trying to do is reduce the friction it traditionally takes to kind of engage in that investor dynamic process.
So a little bit of risk there. I wasn't sure how you were going to answer that question, but I want to follow that up with, there are some great resources like fractional CFOs or a part-time type CFO, because I would tell you that the number one obstacle that we encounter as a traditional bank lender in helping people is them providing us with quality enough financial information for us to understand what's going on in their business. And once we encounter someone like that and are able to, get them to resources, I think both parties really benefit. They understand more about their business and we understand a lot more about their business. And so that's something that I would say, if I see a pitfall in a small business and something that hampers its growth, it's in not being able to understand, do they need to work harder on the revenue side or the expense side? What's the trade-off there? And so, engaging some of these fractional CFOs, these are, people with incredible experience who can give you just a portion of their time for an appropriate fee and really accelerate your opportunity to participate in any one of the three funding sources that are presented here today.
Yeah, actually, that's the role of many of the mentors that are with Capital Factory also. Arun is one of them. Whenever somebody has these projections and everything else on the financials, Arun actually goes through them and really gives them a lot of feedback around that, because he has seen several of these deals and he feels in terms of the projections how to be realistic and everything else and things that make sense. So I'll maybe let him talk about what he has done with some of these startups. So.
Yeah, no, that's right. So just, getting a look at the financials, saying, hey, just send me the Excel and I'll spend a few minutes going through it. You want to make sure that you're, Jonathan, you're speaking of the historical financials a little bit, but to understand the business. But I guess, depending on how deep on the equity stack you're going, then you want to be more and more about the upside potential versus just the base case and downside protection, which is more on the debt side. So when you're looking at the upside potential and you want to show your business as having a lot of upside to attract equity investment, you need to have realistic projections, but also exciting projections. And so that's a balancing act, because obviously, too conservative is not going to excite anybody. Too exciting, too aggressive is going to make people question your being in touch with reality. So that's kind of the important thing to do there. And the thing that I've always heard from others and also endorse myself is your projections are going to be wrong no matter what. But you have to have a directional story on how you get them and how you plan to run your business. So if you're showing that you can achieve a certain amount of sales in the next 2 to 3 years, then have some assumptions that underlie those numbers that talk about how many customers does that mean? How many, what's the pricing on those? Is that pricing realistic for this customer base? Is the customer base large enough so that you can capture the amount that you're talking about? Because if you have to capture your entire market, then obviously that's not going to happen. So these are the things that you look at when you look at the financials. And if you can capture these assumptions and put them down so that they're realistic, then anybody who's investing in you is going to be more excited about your business, whether it's a bank or an equity investor.
Excellent. Thank you. I think we are about time to shift to some of the audience questions. And we have one from Christine asking a question to Yongro, saying, how often do companies that come to you need branding, website, and other marketing help?
Yeah, I mean, I think it's just case by case, but definitely every company needs help with branding and marketing, right? No matter what you are. And so I think that's also so what we try to do is, at least on the offering process, try to provide a professional kind of interface so that the investors interacting with them can feel that the team is really disciplined, or whatever the relevant characteristics might be. When they do their own own businesses, they need help. And I mean, so that's the part, to be honest, like we don't really get involved in that side of it because our service is really to the financial kind of fundraising part. But we do have general partners in our community that we always try to refer, or somebody specifically says, hey, I need help with X, and if we happen to know somebody doing X, then we'll try to make the connection and things like that.
Excellent. Excellent. Hope that answers Christine's question. My assumption would be that she is offering those services and maybe would want to partner with you at some point, right?
Yeah, I mean, the one general, because we actually get a lot of inbound inquiries, to be honest, from all kinds of service providers, whether it's marketing or legal or accounting. They always ask us, hey, like, can we work with your clients? And what I've actually noticed is a lot of small businesses get bombarded so often from every type of service providers you can imagine. And the ones that actually are really successful with them, I noticed, is the ones that actually build real relationships. I think that's commonality in everything, right? Nobody wants to be necessarily sold. They want to buy what they think is valuable. So I mean, that's really the value of Capital Factory, I imagine, where you're trying to bring a lot of ecosystem providers out there. So I think any service providers, like, people see that, including ours. Like, when we were a startup, when we were like doing nothing, the initial lawyer that we hired was the guy who was willing to just like work with us because he just believed in us and was giving us massive discounts. And now we've been, paying him hundreds of thousands of dollars, right? Like, and same with like our designers and things like that. So I think definitely try to build a relationship with Capital Factory or other kind of ecosystem builders and be a part of that community, whether it's startup, small businesses, and that'll be very, very appreciated by the entrepreneurs themselves.
Excellent. Excellent. Do we have any other questions from the members or from the audience? You can either raise your hand or type in your question as you have it.
I actually had a question for Youngro, since there's no questions in the chat. I was going to ask you, how often are you seeing the revenue type financing that you mentioned earlier, like the 1.3x based on revenue? That's another one that's popped up recently. I'm curious at how often you're seeing that on your site.
We actually, that's the most popular form of financing on our platform. So, I mean, again, our business model wasn't trying to be AngelList, right? Trying to fund startups, tech startups. We really focus on what we call experiential businesses, which are businesses that are generally cash flow oriented because it's selling an experience. And food and beverage obviously is one theme, but things like fitness, wellness. If you look at your credit card statement, probably the businesses that you go to are the experiential businesses. So if you can think about that, right? Like you can't look at it as equity investments because like that's just not the right category. But they're solid businesses that can possibly give you 10% returns every year as long as they're doing well. So like in that context, this revenue sharing security, we believe, is a good way to align the risk reward. Because for investors who want to invest in these cash flow into businesses, but it's just annoying or hard to structure equity, when you do revenue sharing, it's pretty simple. It's like, okay, the more revenues you get, the more I get, and I am taking the downside risk as well, but it's a very different, more appropriate risk profile than obviously a straight equity investment or straight debt investment.
Mm-hmm. Thank you.
I had a question for Jonathan, because we do both from startups as well as small businesses. Obviously, again, everybody want to get bank loan if they can. And I mean, not to be so direct, but one feedback that we get is no matter what, like the bank says, you got to personally guarantee. And if you don't have real assets to guarantee, it doesn't matter how good your business, you're just not getting it. And I know banks give the politically correct answers, but if you don't mind just being direct about how that is, because a lot of, that's why, to be honest, I tell a lot of entrepreneurs, like, look, if you don't have the assets to guarantee it, just like literally don't waste your time, because you're not going to get a bank that. I just want to get your frank advice on how entrepreneurs should think about that dynamic.
So I think there's a sort of three pathways that I would take them down. If we're talking about something that's asset intensive, then, you know, as you de-lever the transaction, then non-recourse or not personally guaranteeing it is an option. I would say that though, for most of those folks, it's going to fall into this category of leveraging some sort of government guarantee program, right? And the bad word, the three letters that no one wants to hear when they come to the bank, are SBA. What I would say is that is a little bit of a tedious process, but look, Yongro, you and Arun have both said, we're an expensive way to raise capital. We're appropriate in a lot of ways, but spend some time exploring these alternatives. So no one likes to hear SBA because that means it's going to take way too long, and there are some additional expenses over what traditional bank debt is. But I would say, so that's kind of the second way that you can avoid that. So just be open to having that discussion. Don't be closed-minded about it. And then the third piece of that is, and what we sometimes see happen is, we see a borrower, and this is tough, it's a very unique circumstance, but we see them identify someone who may have put some equity into you know, their business, who is willing for maybe a little bit of additional percentage ownership or for a flat fee to provide a guarantee to the bank. So, you know, if I go in order of most likely, the SBA route's going to be most likely because it doesn't still require you to give up some ownership percentage, you know, or happen to have, you know, that uncle, friend, angel who can, you know, sign, kiss the paper, but sign the guarantee. So that's kind of step one. Step two would be, you know, maybe there are some additional assets that you can pledge, or, you know, what you're looking to purchase, you know, you can raise a little bit of extra capital and de-lever the transaction. And on the real estate side, that's what we're seeing happen a lot more now. When people are using alternative mechanisms of raising capital, they're just having an additional raise there, and they're either sitting on additional liquidity or they're putting it in the transaction. Both of those have a lot of appeal to a bank. And so that would kind of be the second option there that I would say occurs. But to your point, that's why the startups are so hard for us to deal with, is because you know, the people haven't built the balance sheet. They're looking to build their balance sheet. And usually they have a great idea and a great process. And that's where I think telling that story becomes all that more important. How you tell the story and the data that you use to tell the story, right? The thought process behind the projection or the market share, the size of the market versus, you know, where we think we can grab our market share. So, but banks are the bad guys in that way. I mean, that's a fair criticism of banks. And I do think that you're starting to see them have to respond. I mean, competition is changing now. We used to never do any loan without a personal guarantee. It's certainly not something that happens, you know, even 50% of the time now, but I would say that it's 25 to 30% of the time where, you know, I can remember a time when it was a non-starter. We weren't going to go any further into the discussion. So.
And just to add to that, and Jonathan, really appreciate your candor for those listening. The way to be the exception that Jonathan's talking about is to build personal relationship with the banker. And this is the real talk version. It's usually going to happen at a smaller bank like Vera Bank and not Chase or Wells Fargo. We're never going to happen in those big cases because big banks have very, very clear restriction. Like literally they cannot make any exceptions. But a lot of community-based banks, a lot of local regional banks do still have discretion, especially on smaller amounts, that if you do have a personal reputation or relationship, it will be more likely for you to be the exception, you know, that the bank will provide in terms of, you know, giving a little more flexibility.
Looks like we got a couple more questions here. Let me open this up. There's a question saying, are you investing in restaurants right now? If so, what do you look for or find appealing when investing during a pandemic?
I assume that's a question for me. I mean, so we don't invest directly, but we do work with a lot of restaurants, as you can see from our website. So yeah, some have actually been successful raising capital even during the pandemic. I think the answer to that question is really across any businesses. It's all about the team, right? It's really the team and how they're going to approach a problem. So I will say from a restaurant perspective, really food and beverage, it's the entrepreneurs who are thinking of new ways. Even among restaurants, there's delivery models, there's takeout models, like ghost kitchens are really popular right now. There's different ways to think about any problem that I think reflects the reality of COVID. So I think if a team or a company is doing that in any industry, but especially restaurants, it in fact could be even more amazing opportunities for them whenever we're past this, because unfortunately the inefficient models are probably not going to be able to make it. The ones that are remaining are probably going to be even stronger. So I think if you're really strategically thinking about how things work, especially from a contrarian mindset, it may be helpful for you to evaluate different opportunities.
Excellent. And I'll have a final question here, maybe from each of you to close this panel. What would be one critical advice that you would give to a business right now?
I'll just go because I was talking. One thing is just, I know it sounds silly, but don't give up. Right, that's really the number one thing. Don't give up. I mean, if you give up, nothing else matters. And obviously, it's very easy to do. And sometimes you have no choice. In which case, obviously, you should, manage your risks and try to find a way to transition out, as well as you can. But to the extent that you have some options, even if you have to work a little harder, right? If you can survive this pandemic, you can do anything else. So I'll just generally say, don't give up.
Excellent.
Yeah, I like that. I like that one, Yongro. I'll say really start if you haven't done already, is get a sense of where your customers are, and that means personally as well. If you have personal relationships with your customers, which you should have, get out there and find out what's bugging them. Figure out a way to accommodate them during this time as much as possible, even though it may hurt a little bit. Because there's one thing I saw from the last recession is that we had a business we invested in that had a lot of small businesses as clients, and it was related to HR outsourcing. And so they got paid based on the number of employees that their client companies had. And we saw that they lost a lot of client employees during the recession, but they didn't lose a lot of clients. And they took care of those clients even though they cut their staff in half. And when the economy came back, those clients stayed with the business and they grew faster. So do everything you can to keep your clients, even though the clients may be doing less business with you through this time, and you'll prosper when it comes out. And that happens in all businesses. I've seen graphs about that happening in tech, where in the last recession, SaaS or software as a service recurring revenues dropped by 30%, but they retained the clients, and then they went up 70, 80% right after. So it's just it's a really important thing to keep those relationships. Customer relationships are really hard to win, and so investing in keeping those as fresh as possible is really important.
Perfect. Jonathan?
Two tough acts to follow there. I'm going to kind of go back to a comment that Yongro made earlier, which is focus on that relationship. And Arun just finished that with on the business side, but on the bank side, have an honest conversation. Don't be afraid to do that. I got an email from a customer early in the morning, which leads me to believe that she was up just, in knots, worried about sending me this email that, hey, things have been really bad and we're closed. And I said, I know that. And her comment was, I want to wait until I can talk to my accountant. And I said, I don't need to see any numbers from you. I just want you to tell me what's going on. And so I would say that, hey, there is a lot of bad news out there. Share the bad news. You probably will feel better after you have that conversation and kind of rip that Band-Aid off. Banks are doing a couple of things. And I feel like, again, the smaller the bank, I'm advocating for community banks, to be honest with you. Certainly, look, we're a small business, we're a business and we're looking to grow. but partner with your community bank. Maybe your neighbor works there. Get to know them and ask them, who can I sit down and have a coffee with and get to know? So we're advocating at this point for community banks where there is some of that flexibility, but banks are really going to bat for their customers, especially here in Texas, where going back, a few decades ago, there was overreaction to, economic downturn, and it was detrimental for all parties involved. So we're having monthly conversations with the regulators that we deal with, and we're kind of telling them, look, this is what needs to happen. We're not going to be successful all the time, but we're trying to provide flexibility, whether that's payment relief, cutting fees, anything that we can do to help people get through this. So don't be afraid to have that honest conversation that you've probably never thought of having with your banker. Go ahead and just let them know, and just sit down and talk with them.
Excellent, excellent. I'll hand over to our moderator and go from there. So.
Yeah, thank you so much all our today. So thank you, Shakeel, for being our moderator today. A huge thank again to our Chilling and also National ACE for your support. Before we close the event, I also want to add one more note. So we have our upcoming candidate forum this Saturday, and we do have more events to come in September. So make sure that you check out our event calendar on our website, and hope everyone stays safe and have a great afternoon.
Thank you very much for your participation, and we really appreciate all the panelists. It is so informative, and personally, I learned a lot. And I appreciate the most is during this difficult time, you have such a great positive message and encourage all of us to move on. Thank you.
Thank you.
Thank you. Take care.